Hey everyone, me Kevin here. The stock market is falling, and in this video, I'd like to explain why. First things first, well, I wanted to make this video yesterday. I thought maybe today things would recover a little bit and we can kind of do a post-mortem on what happened yesterday. And I'm over here in Florida trying to get this flight training done. It's exhausting, but I still want to provide this value to you. And what I noticed yesterday, as we talked about in the course member live streams as well, is there are a few things happening. First thing is you tend to see a really substantial sell-off at the beginning of the day, and then another sell-off at the end of the day. This was actually the Palantir bounce right here. I sent a trade alert on some call options on, which we did have a nice rise here, but it certainly wasn't anywhere enough to make up for the drop at the beginning of the day if you were long holding and not just entering on that line. Now today, what's fascinating is we have not stopped that down sell from the opening. Now this could reverse and we could get back here, but this is indicative of something. Usually, when we see markets that dump at the beginning of the day and the end of the day, this doesn't just have to do with Palantir, usually it's indicative of institutional selling. This is the S&P 500 right here. And you can see what's happening right now relative to what happened yesterday. You had the AM sell, midday sort of buy the dip, and then end of the day sell. Now, why does that matter? Well, it's a sign of institutions de-risking. Look, I have a lot of experience with Wall Street and on Wall Street, and I'll tell you, it's not a very fun place to be, mostly because you kind of have to do what's good for business, not necessarily what's best for your investments. You on Wall Street kind of always have to be there to encourage people to buy, deposit more funds, and of course you have exposure to the latest and greatest stock. The problem with that is it actually removes your ability to have foresight for the market. See, foresight is actually really unpopular in the short term, right? Because foresight would tell you that when stocks are really euphoric, you probably want to sell and go buy something that's super bearish, like bonds, right? But doing that is really unpopular. And so institutions usually don't do that. So publicly, I find this every day. You get institutions that send their sort of bulls out onto the street. Everything's fine, go buy the dip. But then behind the scenes, institutions are putting in these sell orders that we see at AM and PM. Now, of course, AM and PM have the highest volatility, so is it possible that retail is only trading AM and PM as well? I don't think so. I think, it's usually just institutions that are your big AM and PM movers, right after market open, right before market close, mostly because the way you could trade with an institution is you can mark orders as market on close, as an example, right? So you'll put in your order, you'll take your day doing your research and your work, you put in your orders for the end of the day, and you submit them off, and then you go home. And then right before the closing bell in the last 15 minutes, these orders get executed. So that's typical. That's one of the reasons why you see these moves. Now, why would institutions be dumping? That's sort of the big question here. You've got Robinhood down 10%. Well, keep in mind that when the stock market falls, retail investors stop buying stocks as much. Excuse me, still a little under the weather. Shouldn't have gone to China. I thought doing a documentary on Wuhan would be a cool thing. Anyway, so when retail lowers their volume, of course, brokers like Robinhood are going to see lower volumes. And so people are trying to pre-price, okay, market down. Well, Robinhood will go down by a magnifying effect because of their exposure to making money off of the market movements. And usually as markets go down, people don't actually trade more, they trade less, mostly because some of their money has evaporated. Jerome Powell is going around with a giant vacuum cleaner, basically sucking up extra liquidity. But let's talk about some of the other data that's going on. So just this morning, we had the Richmond Fed manufacturing and Philadelphia manufacturing reports that came out. Now, the Richmond Fed one was interesting because they said that activity actually increased somewhat in February, but that was because of a notable increase in shipments. Well, shipments mean old orders have finally gone out the door. So what does the forward information say? So their composite went up because of the shipments issue, or benefit, I guess. But then on the future index, they write the following. The local business conditions index remained at -5 in February, while the index for future local business conditions fell from 32 to 2. The futures index for shipments and new orders also decreased substantially from 13 and 8, to 13 and 8 respectively. So both of those plummeted. Vendor backlog times also decreased. So that's not great. So all of that kind of went in the poopers. Okay, well, what else did we get this morning? Because that report on the headline, if you just read the headline, it'd be like, oh, it looks like it did a little bit better than expected. Oh, boy, go buy the dip. But then when you actually look at the detail, it's like, wait a minute. The old stuff is good. The new stuff is bad. Okay, so that's Richmond Fed. But then we also got the Philadelphia Fed report this morning. We covered all of this in the course member live stream, which keep in mind, we've got a large, this is going to be the largest price increase ever at the end of this month for the courses. So go to meetkevin.com if you want to be in. You pay once, you get lifetime access. And we're probably going to be doing mini masterminds later in this year. No guarantees, but it'll be for course members only. And the goal is to get the entry price up to $800 to $1,000. Right now, it's a fraction of that. So check that out over at meetkevin.com. You'll be really happy if you join sooner rather than later. And hey, we were live this morning for over an hour and a half. Just talking about what's going on as the market opens. So if you still want those market open live streams, you can get those in the course member live streams every single day. I even do weekends. Really just trying to provide as much value as I can to course members, and you just get, raw Kevin every day. Raw dog Kevin. Oh boy. Anyway, so Philadelphia Federal Reserve Bank indicated this morning the following. Manufacturing activity declined this month, according to firms responding to February's non-manufacturing business outlook. The index for general activity at the firm level, new orders, and sales and revenue all declined into the negative territory. Firms continue to report overall increases in full and part-time employment. That's actually good. And price indices suggest little change in the prices of firms' own goods and services, but continue to indicate an increase in the price for inputs. So this is what I've been saying for a year now, is that companies don't have the pricing power to keep raising prices on you, with the exception of, food and eggs and insurance. They do because, out of the whole basket of everything, insurance substantially lags. And then, we generally look at food as very volatile just because supply chains, because of bird flus and things can be very volatile. Same with energy. But for most goods and services, you have pricing issues. In fact, if you look at the Philly Fed one, going back to this one, it actually says the average growth rate of prices edged down. Look at Home Depot. Home Depot is forecasting growth of 1% in comp sales. Inflation is going to be higher than 1%. So they are actually shrinking on a real basis, an inflation-adjusted basis. Continuing on, they indicate that this was the first negative read in employment since April, in the employment work week. So usually when the average work week falls, that's a precursor to people getting laid off. Layoffs happen last. People keep going on CNBC. They're like, but the economy's good because unemployment is low. When unemployment peaks, you are already at the bottom of the stock market. That's buy time. Current indicators declined to the worst level since April of 2023. And we had the future regional activity index turn slightly negative, its first negative read since August. So the Philadelphia Fed report this morning was bad. The Richmond Fed report this morning was bad. Those are just from this morning. Last week's S&P PMI report that I covered was terrible. It was really bad. You should look it up if you haven't seen it yet. S&P PMI report on business. You could literally just Google that. And you'll find the February, here, you just go there. See, S&P Global Flash US PMI report. Pop that open. Please, I encourage you, this is your homework, read it. I'll just read you the first line because I've already covered this. I don't want to sound redundant. But just as a reminder, U.S. business activity growth came close to stalling in February. So, no, why is the stock market going down? Wow, maybe because institutions are actually reading these reports. And while their minions are going on CNBC telling you everything is okay, they're actually in the back offices going, oh, shit. Look, there's something you have to remember. And I'm not saying this to be, a bear on Trump. But there's something you have to remember about Trump policies. Trump policies are growth negative at the beginning, growth positive at the end. So think about that for a moment. What does that actually mean? What am I saying? When you fire people, even because of waste, I'm not making a political argument here. I'm just saying, fact of the matter is, when you fire people, growth contracts. Simple. When you tariffs are terrible economic policy. And they're nowhere near good enough to help offset our tax revenues. But that's okay. This is not political. It's just simply stating. Both of those together are growth negative policies. Uncertainty around, what's going on with Ukraine or whatever, or are we going to turn the Gaza Strip into, a new Monaco? These are all uncertainties that are growth negative, right? Because we look and we go, oh my gosh, what's going to happen? What's going to happen? What's going to happen? And we don't know. Ro Khanna had an interesting argument. He's like, look, Trump, if you just said, because Ro Khanna's a Democrat, he's like, look, if you just said this is what the tariffs are going to be, great, then we can plan for it. But what's actually happening, it's sort of like, hey, we're going to do 25% tariffs. Just kidding. We're going to have more troops at the Canadian border. And you know what? Yeah, we're actually still working retaliatory tariffs on Canada. And people are like, bro, this is not to be anti-Trump. It's just simply to make the statement that confusion does create uncertainties which make people less confident in buying, and they are growth negative for the time being. Now, consider that for a moment. Growth negative at first eventually is supposed to be offset by what? Well, tax cuts, right? Let's get some water here. Florida tap water, baby. All right. So if you have growth negative policy that hits first, later, the goal is to get growth positive policy. But that takes going through Congress, right? You have to get your tax policy through Congress. You have to get your tax cuts through Congress. What is this? Okay, I thought I only had tea and decaf coffee. Oh, I need real coffee. But anyway, thanks, Marriott. Tax policy is going to take a while to actually implement. The tax policy won't actually probably come until we get to 2026. That's probably when we'll actually see our tax policy. So if we have to wait until 2026 to see growth positive regulatory cuts, more certainty, and tax cuts, well, by then the economy could be in a deep, dark recession. Now, I'm not praying for that because I think that's very bad. I do think there are ways you can hedge for that. Specifically, I'm a big fan of bonds, TLT. I think TLT, $95 call options 2026 and $100 call options 2027 are quite interesting as a hedge for this. You have to look at them as a hedge because, look, bonds do great when the economy does poorly. And, the economy only does poorly 2 out of every 7 years. So statistically, if you were going to throw a dart, you're more likely to hit a bull market, right? That said, this latest data has moved me from a 4.5 on the bull-bear scale, or bear-bull scale, down to like a 2.5. The latest data is bad. But what about Apple? Apple and its $500 billion investment? Let me tell you about that scam.
And now for a message from our paid sponsor, Helium Mobile. All right, folks, y'all know I love good deals, and the fact is, I also love having good reception. This is why I have 4 different cell plans on my phone. Now, you don't have to be like me, but you probably only have one. And maybe you need a better one, or you need a second one. And I encourage you to check out Helium Mobile. One of the reasons I do is because they actually have a free option. So you can install a second plan on your phone. It's another SIM, like an eSIM, for free. The free plan gives you 3 gigabytes of data, 100 minutes of calls, and 300 texts, all at no cost. You go to their website, Helium Mobile, and see the 3 different options that you could tab through: the Zero tab, the Air tab, the Infinity tab. What's great is they give you a breakdown of exactly what's included, so it's super transparent. One of the reasons they can offer you a free plan is because you get rewarded for sharing anonymized data that helps them improve their network. You also end up getting the potential for gift card rewards to things like Uber and DoorDash, Nike, Airbnb, you name it. If you need more data, they've got insanely inexpensive plans compared to some of the, current bills you might be facing. And so as a result, I encourage you to check them out. Helium Mobile. The only way to get in right now is by joining my exclusive waitlist. So make sure you use my link invite in the description down below and use code Kevin. That'll help you lock in your spot on the waitlist. That way you can start saving some real money or get that second backup option.
True story, by the way. I have 4 different cell services on my phone because when I'm traveling like this for work, I want to make sure I always have cell service. Anyway, let's talk about the Apple scam. So, look, I like Apple. I like Apple a lot. I think they're a great company. I'm a big fan of their leadership. But when I heard Apple say that they're going to invest $500 billion over the next 4 years in data centers to support their, private cloud data centers, which isn't really AI cloud, that would be, these AI data centers. I mean, I suppose they could be AI for like the internal neural nets that they want to use, but they really want to run these on your devices. So I suppose it would be more like protected cloud for things you want to upload on your iCloud or whatever, and then audited servers, data centers that are protected. These are somewhat different from GPU-based data centers. They might be more, hard drive-based data centers, but there'll probably also be some GPU data centers. It might be a mix of both. But Apple made this announcement that they want to create 20,000 jobs over the next 4 years, ideally, sort of exactly matched with that Trump administration. It's a bend the knee is what it is, right? I mean, Meta bent the knee for Trump and their stock went up like 25%. And so, people are kind of like, oh boy, let's go support Trump because it makes our stock go up. That's fine. Again, I'm not here to be political, but what I am here to do is look, and I was joking about this with course members this morning. I'm like, the meeting between Apple and Trump probably went something like, oh, hey, Trump, we'll invest all of our cash flow into the United States. Please don't tariff us. And this is what they did kind of in 2018, where you had this Chinese tariff war going on and the Chinese sword initiatives. And Donald Trump exempted Apple from a lot of the tariffs and actually ended up giving CEO Tim Cook CEO Tim Cook ended up giving Trump one of the first of the new models of Macs that were released because of this sort of relationship that they were able to earn and the exempting that Apple got for tariffs, which is mission critical for them because of how much they manufacture overseas and then also how much they sell overseas. But then I look and I go, well, wait a second, Apple. If I look at your balance sheet, in current assets, you all have about $65 billion, which is cool, but it's a far cry from $500 billion. So then I'm like, all right, well, what's their cash flow? And that's where I figured it out. Their year-end cash flow is about $120 billion, which is fantastic. But that basically means they are saying, hey, Mr. Trump, we will invest 105% of our next 4 years of cash flow, or 100% of our next 4 years of, projected cash flow back into the United States. Trump's probably like, can you all do more? But this is actually a good thing, right? Because you have a president who is encouraging businesses to invest in America. And, a lot of people see that as very good. Create American jobs. At some point, those data centers will create more American demand for goods and services, restaurants around those data centers, the construction industry that gets supported there. I'm a big fan of those sort of announcements from the private sector. They're actually not too dissimilar from the Biden administration announcing the CHIPS Act and investments into America, right? Except rather than the government making the investment announcements, it's private enterprise doing that for the benefit of them potentially being exempt from tariffs. This is the goal of Trump. The whole point here is to try to get businesses to invest in America. So I see the point. In the short term, it does create some uncertainty stuff. So, is the Apple investment announcement a scam? No, it's just, it implies they have all the money now and they're really just promising their future cash flow. And I personally don't think that promising your future cash flow for investments is a sound investment decision, because you just don't know what's going to happen between now and then. But that's just my take, okay? So then Microsoft, this was an interesting one. Microsoft came out and said, there's some people in the rumor mill talking about our us cutting leases, which I made a video on this. And they basically said, so the news is true, but we're going to reinvest that money into something else. See, I personally actually think that a lot of these companies are going to realize they've overbilled LLM investments, language model investments. And I actually think you're going to see a big movement towards other types of CapEx. So I think they'll still spend the CapEx, but it'll go to things like actuators and batteries for robotics rather than just data centers for LLMs. That's my take. But something to look at as well, just some other data points here. Microsoft, while it fell yesterday due to these lease cancellations and Nvidia was down 3.1% on the news, you do have Nvidia earnings coming up. And I actually think Nvidia earnings will be quite bullish, mostly because they're like never not bullish. When have you ever heard of Jensen go up and not tell you about the multi-trillion-dollar investment opportunity on the horizon? You are going to get a bullish Jensen Huang. Now, are you going to get the same levels of growth projections? Well, I don't know. I guess we'll see. Usually Nvidia beats and raises. So the market's already expecting a beat and raise. Will it be enough? You know, Home Depot stock's down today and they technically beat, but their growth was trash. I mean, to some extent, they're even expecting negative growth. So I'm not like purely optimistic. Now that said, am I, a mega bear? Well, I always just like to use my bear bull scale. I also really like to take a sip of this coffee, but it's too hot right now. So I have been under a 5 on the bear bull scale. So, 1 is sell everything. 10 is all in on margin. I've been under a 5 since last summer. Now that's been disappointing because to some extent that means I've been more bearish than I should have been during the Trump enthusiasm phase, which was, an incredible run. But when we actually look at the underlying fundamental data, we look and say, okay, is it possible that we pulled forward a lot of production and goods and service spending in anticipation that everything's going to be great in 2025, and then all of a sudden 2025 hits and it's like, oh, more uncertainty, tariff uncertainty, tax uncertainty, the benefits aren't here yet, of course. I mean, we knew this. We read this like a book before it happened. Pricing power is limited. Like at some point, the slowdown will hit. And, if institutions are just talking about, oh, well, jobs are still good, then I think they're just, again, sending their lying minions on CNBC to tell you that everything is fine when the reality is it's not. And when you look at hedge fund exposure to the Mag 7 right now, people are actually joking that it's going to be called the Lag 7 because hedge fund exposure to the Mag 7 right now is at the lowest level that we've seen in years. People are talking about how even Baba sold off after they announced $53 billion of infrastructure spend, and they see that as potentially a negative catalyst for Nvidia. Although Baba's actually popped up today. Baba's been doing great since they're doubling down on AI. So a lot of people actually on the flip side are taking the opposite side of that trade, and they're saying, nah, man, all in on China, baby. If the U.S. is going to slow down, we'll go to China. That's fine. I'll just be transparent. I'm not as well educated on China, so I try to stay away from opining on everything Chinese. Starbucks we saw cutting jobs. Southwest cutting some jobs. Hims losing its access to, I could probably never pronounce it right, but semaglutide. That's not so great for Hims. That's been one of their highest margin products and highest. I think they charge somewhere around $199 a month to have somebody come in and be a member and have access to semaglutide through Hims, whereas they charge normal members like $39 to $59 a month, I believe it is. So, you're getting a lot more margin over there. But, we've done a whole analysis on Hims in the course member live streams you can go check out where we actually go deep on this. But anywho, the current latest that we have from Trump on tariffs is that Canada and Mexico tariffs are going to be, quote, on time now and moving along very rapidly. Those are quotes from Trump, following an initial delay until March 4th, which is already next week, which is crazy. It means that coupon expiration is coming up at the end of this month already. That's wild. February 20th. That's going to be a big one. That's going to be one of the biggest price hikes in a very, very long time. And it's mostly because as we start initiating doing local meetups later this year, the entry price is going to be a lot higher. Bond. And then there's this talk about TLT being at some of its highest levels of short interest in quite a while, creating what a lot of people argue is a potential buy the dip opportunity in bonds. But then again, I have exposure to bonds, so I don't want to sound biased. But I found that very interesting that short interest is so high, probably because it's made a lot of money. You shorted bonds, you made a lot of money. Now, another thing that I'd like to talk about is Microstrategy and Michael Saylor. So Michael Saylor bought like $2 billion of Bitcoin again at somewhere around $95 billion, and it basically did absolutely nothing for the stock, which I thought was very, very interesting because, much like other people are like, usually when Michael Saylor buys, Bitcoin goes up. But that didn't happen right now, and I think that's because, again, the institutions they're not being transparent to your face in that they're just secretly degrossing substantially, and that includes degrossing on whether they have altcoin exposure or Bitcoin exposure or whatever. It's basically all turning into sell, which could be very short term. It's entirely possible that we get Nvidia with some banger earnings tomorrow and everything just goes back to the moon and we go back to normal and this was just a short term buy the dip opportunity. Fine. The reports that we're reading, the PMIs, Richmond, Philly Feds, University of Michigan sentiment, and some of the other data we're getting, they don't necessarily agree with that. But hey, who knows? Maybe that'll spawn new investment. But I think one of the reasons why Bitcoin didn't actually move up substantially after the Saylor $2 billion buy is because you basically just matched that with another $2 billion of sells. See, that doesn't even necessarily have to be on the public Bitcoin market. It could be done through what we call dark pools, which I know I'm going to get a lot of people, Kevin, it's blockchain. It can't be dark pool. Dark pool doesn't mean that it's not like that we'll never see it. It just means that it's not done through your open and public market. So, for example, let's say you have Goldman Sachs that says, hey, we've helped y'all do so much in bond offerings. We want to help you with another bond offering, MicroStrategy. We've made so much money off y'all in commissions. By the way, we have about $2 billion of Bitcoin that we want to offload. And I'm just speculating here, right? But I just want to explain how it could work. We have $2 billion of Bitcoin that we want to offload. Next time you guys raise money and want to buy Bitcoin, can we just sell it to you directly? So that's still going to appear like an on-chain transaction, but it's not going to appear like a giant candlestick on the public pricing markets for Bitcoin, because it could just be an agreed upon market price. Okay, we'll put the transaction through. We'll trade that $2 billion with you, and you'll still see that on blockchain, but you won't see that necessarily on like, somebody put in limit order buy $2 billion of Bitcoin, you'd see these giant candles up, or somebody put 2 billion sell, you'd see these giant candlesticks down. Instead, you're just matching a buyer and seller at probably roughly what market price is, and then you can see the volume, but the price doesn't move. That's just an example of how this could potentially work. That's at least how these, I guess maybe a better word than dark pool would be to call it block transactions, right? This is frequently done on Wall Street, and so it can be done in crypto as well. Just basically manually arranging a buyer and a seller. Very, very common. So what does this actually mean, though, for the long term? Well, a Bitcoin sell down, Michael Saylor believes, would actually be totally fine for MicroStrategy, because they say that even if they had to pay their bonds back and the company value went down because Bitcoin went down, they would just be able to pay people back in cheaper MicroStrategy stock. I don't know what Michael Saylor is smoking, but that's not how bonds work. When you sell convertible bonds, you're promising to pay people back in cash when the bonds mature. Well, unless you have the cash, you're going to have to sell your stock at a lower level to pay people back in that cash. They're not going to take MicroStrategy stock at a lower level. Most of the convertible bonds that I've been studying for MicroStrategy all have conversion prices that are way higher than where they are now. The last time I looked at a MicroStrategy bond, it had conversion prices for like 2028 at like $650. And so if it didn't convert at $650, people get their cash back. Well, how are you going to pay people back if the stock is $200? Well, that's probably a lot easier than if the stock is $25. So that's going to be something to pay attention to in the next cycle. That's not to be bearish Bitcoin. It's actually to be bearish MicroStrategy. Same. That's they've set themselves up for quite a lot of debt at a higher cost basis, right? So that's going to be something to pay attention to. All right. So now we've talked artificial intelligence, Bitcoin. We need to talk housing. So, see housing out there? I'm a big fan. But it depends on the location. Right now, Florida and Texas and many parts of the country, including some parts of DC, are going through a supply shock. More inventory is coming on the market at the beginning of the year than buyers are showing up. That is a positive supply shock, which typically leads to a reduction in prices. That creates an opportunity. And that is where I personally see an opportunity to move more of my own money into HouseHack. Yes, I know. Selfish plug, I suppose. But here's what I love about HouseHack. First of all, our Reg A should be out within the next week or two. We'll probably talk to course members about it first, but I'm not sure how long it'll be. It could be even longer. So this video is not a solicitation because there's nothing to do right now. But what we'll probably do is keep doing what we've been doing, which is when we raise money, we buy real estate where we can get it for a discount. That protects us if the market goes down, but it means we're one of the buyers during a panic period. We're raising cash. We pay out our rental yield. It's about 5%, so we pay that out. And if we can grow the value of the company, you get that upside as well. That's basically what we do. But I just buy fixer-uppers, go around the country, buy fixer-uppers, and we expand the business. Right now, we're pretty heavy West Coast, but we're looking to expand towards Texas and Florida. And we actually think, we don't know if that time is right now, but we think soon there will be an opportunity to start buying the dip on Texas and Florida. I think we're getting closer to that buy the dip opportunity. It might still be a year, but we're getting closer. Eventually, they'll bottom out. And then also develop ADUs. So I'm a big fan of real estate. Now, aside from talking about HouseHack, why do I think real estate is so interesting right now? Well, I believe that if the market truly is slowing down, then interest rates are going to plummet. In fact, I think that in the longer term, we'll probably see interest rates come all the way down to the 30-year mortgage will be lower than 2%. We'll end up having a 40 or 50-year mortgage. It'll be under 3%. We'll have lower 30-year mortgage rates than we've ever had before. I think we are heading into more of a deflationary spiral rather than an inflationary second wave. So I think these concerns that like Credit Agricole have about, oh, we're going into stagnation because January's inflation report was slightly high. Whatever, dude. You can believe that. And look, if there's stagflation and a recession, you know what'll do really well is gold. But I actually think we'll have deflation and a recession, which means bonds will do well. Gold could do well because of the recession aspect, but you'll lose the inflation buyers. So real estate is very interesting, though, because if you can own assets that are sensitive to interest rates, this is why I like Rocket Mortgage, United Wholesale. I think some of these are near rock bottom. I'm not saying they're at their bottom yet, but they're near rock bottom. Enphase, housing. These are assets that I think can do really well when rates plummet. And if the stock market slows down, because the economy is starting to slow down and institutions are starting to see the red flags, and that ends up leading to layoffs, then yeah, it's just a matter of time for rates to plummet. And so you want to sort of pre-position and pre-anticipate some of that. So that's my take. And if you want more details and analysis from me, make sure you're part of the courses. Huge price increases coming. So make sure you get in by Friday, the 28th. If you have questions, email us at staff@meetkevin.com. Course member live streams every single day. Buy, sell, trade alerts when I see opportunities. Long-term fundamental analysis. So whether you like long-term, short-term, real estate, stocks, we cover it all. Really encourage you to check it out. Go to meetkevin.com. Thank you so much for being here, folks. And hope to be better soon. Still feel a little under the weather. I'm going to have some coffee now, and we'll see you in the next one. Appreciate y'all. See you. Goodbye and good luck.